When gold hits $4,000 an ounce, something terrible happens to everything else. Not sometimes, always. And right now, as I'm recording this, gold just crossed that line again. The metal that's supposed to protect you when everything falls apart has become the warning bell that everything is about to fall apart. And if you think this is just another market cycle, you're about to learn why every time gold doubles, the financial system doesn't just stumble, it collapses. Most people think gold goes up when stocks go down. Simple inverse relationship, right? Buy gold, sleep well at night while the market crashes around you, but that's not how it works. That's the fairy tale they sell you. The truth is far more brutal and far more useful if you understand it. Gold doesn't rise because it's safe. Gold rises because everything else is breaking. And when gold doubles from its previous highs, it's not celebrating, it's screaming. Let me show you what I mean. In early 2024, gold was trading around $2,000 an ounce. Respectable, boring, the kind of price that makes financial advisors nod approvingly and tell you to put 5% of your portfolio into precious metals for diversification. But by October 2025, gold hit $4,379. That's not diversification. That's desperation. And every time in history, gold has made moves like this. Markets haven't just corrected, they've been obliterated. The pattern is always the same. Gold sits quiet for years, moving in gentle waves that most people ignore. Then something cracks. Not in the gold market, but everywhere else. Currencies start to wobble. Debt begins to suffocate governments. Central banks print money faster than they can count it. And suddenly, gold doesn't just rise, it erupts. But here's the part they never tell you. By the time gold doubles, the crash isn't coming. It's already here. Take the dot-com crash of 2000. Everyone remembers the Nasdaq losing 75% of its value. Entire fortunes built on websites that sold nothing to nobody evaporated overnight. But what they don't remember is that gold was already moving before the first tech stock collapsed. It bottomed at $255 in 2001, but smart money was already flowing into precious metals months before the bubble burst. The doubling didn't cause the crash. The crash caused the doubling, the same script played out in 2008. While banks were still pretending subprime mortgages were AAA investments, gold was climbing from $650 toward $1,000. The metal was pricing in catastrophe, while Wall Street was still handing out bonuses. When Lehman Brothers finally collapsed in September, gold didn't surge because of the news. It had already been screaming warnings for months. The doubling was the market's way of saying the entire financial system was built on lies. But here's where it gets dangerous. Gold's behavior during crashes isn't what most people expect. In March 2008, as the magnitude of the financial crisis became clear, gold didn't keep rising. It crashed. Hard. From over $1,000 down to $692 in a matter of months. Even the ultimate safe haven got crushed when everyone needed cash more than they needed safety. The lesson is brutal but clear. When liquidity vanishes, everything falls, even gold. Yet after that initial panic selling, something extraordinary happened. Gold began a relentless climb that lasted 3 years. From $765 in November 2008 to $1,873 in September 2011. Almost a $1,000 gain while the rest of the world was still digging out from the wreckage. That's not luck, that's the pattern. Gold gets hammered in the immediate chaos, then becomes the only thing standing as governments destroy their currencies, trying to fix what they broke. The Great Depression tells the same story, just with bigger numbers. While the Dow Jones lost 89% of its value and breadlines stretched around city blocks, gold mining stocks didn't just survive, they thrived. Homestake mining rose tenfold during the worst economic collapse in American history. Not because gold mining suddenly became more profitable, but because gold became the only store of value that governments couldn't print away or manipulate into worthlessness. Today's situation is eerily familiar, but with one crucial difference. The scale is global. In the 1930s, the damage was mostly contained to developed economies. In 2008, it spread worldwide, but governments still had room to cut interest rates and print money. Now, central banks are trapped. Interest rates are already near zero. In most developed countries, debt levels are astronomical, and they're still printing trillions every time something threatens to break. That's why gold's move above $4,000 isn't just a price milestone, it's a referendum on every major currency on Earth. When the People's Bank of China bought 220 tons of gold in just one quarter, they weren't diversifying, they were preparing. When the National Bank of Kazakhstan quietly accumulated more gold than most countries hold in total reserves, they weren't investing. They were positioning for what comes next. The numbers don't lie. Central banks worldwide purchased 634 tons of gold in the first 3 quarters of 2025 alone. That's not normal accumulation. That's panic buying by the institutions that print money for a living. They know something the rest of us are just starting to figure out. The system they built can't survive what's coming. And what's coming isn't just another recession or market correction. It's a complete reset of how money works. Because when gold doubles, it's not celebrating higher prices. It's pricing in the death of currencies. Every time in history this has happened, entire monetary systems have collapsed. The only question is whether you'll be prepared when the doubling turns into tripling and tripling turns into the kind of hyperinflation that makes wheelbarrows full of cash look quaint. Gold at $4,000 isn't the top, it's the beginning. The warning signs are everywhere if you know where to look. Modern research shows that gold's relationship with stock markets has fundamentally changed since 2006. Before that, gold moved independently, rising when stocks fell and falling when stocks rose. Clean. Predictable. The kind of inverse correlation that made portfolio managers sleep well at night. But something broke after the housing bubble burst. Gold started moving with stocks during crashes, not against them. That means when everything falls apart, gold falls too, at least initially. This shift makes the current situation terrifying. Gold hitting $4,000 while stock markets are still near all-time highs isn't normal, it's unprecedented. In every previous cycle, gold doubled during or after major market collapses. This time, it's doubling before the collapse. That suggests the smart money already knows what's coming, and they're positioning for devastation on a scale we haven't seen before. The mechanics are simple but brutal. When gold doubles, it signals that massive amounts of capital are fleeing traditional investments. Not retail investors buying a few coins for their safe institutional money. Sovereign wealth funds. Central banks. The kind of money that moves markets and topples governments. These aren't emotional decisions based on fear. These are calculated moves by people who have access to information the rest of us won't see until it's too late. Think about what it means when central banks buy gold. These are the institutions that create money out of thin air. They can print dollars, euros, yen, whatever currency they control. But they can't print gold. So when the Federal Reserve's counterparts around the world start hoarding physical metal instead of each other's currencies, they're essentially saying the entire fiat money system is doomed. They're preparing for a world where paper promises become worthless and only tangible assets hold value. The velocity of the current gold surge is what makes it dangerous. Previous doublings took years to unfold. Gold rose from $255 to over $500 during the early 2000s, but it happened gradually. Same with the 2008 to 2011 run from $700 to $1,800. Those were measured climbs that gave investors time to adjust. This time gold has rocketed from $2,000 to over $4,000 in less than 2 years. That's not a bull market, that's a panic. And the panic isn't random. It's being driven by fundamental breakdowns in the global financial system that most people don't understand until it's too late. Debt levels in developed countries have reached levels that would have been considered impossible just decades ago. Japan's debt to GDP ratio exceeds 250%. The United States is approaching 130%. These aren't sustainable numbers. They're terminal diagnoses for entire economies. When governments owe more than their entire economic output, they have three choices: default and crash the system, raise taxes to crushing levels and destroy economic growth, or print money and destroy the currency. History shows they always choose option 3. And when they do, gold doesn't just rise, it explodes. Because suddenly, everyone realizes that the money in their bank accounts, their retirement funds, their savings, is backed by nothing more than promises from bankrupt governments. The geopolitical tensions making headlines aren't helping. Wars require financing, and when governments are already drowning in debt, they finance wars the same way they finance everything else. They print money. The conflict in Eastern Europe has already forced NATO countries to dramatically increase defense spending. That money has to come from somewhere. And when you're already running massive budget deficits, somewhere means the printing press. China's accumulation of gold takes on new meaning in this context. They're not just diversifying reserves, they're building a war chest for economic warfare. When the dollar finally loses its status as the global reserve currency, and it will, the country with the most gold will write the rules for whatever comes next. China understands this. Russia understands this. Even smaller countries like Kazakhstan are frantically accumulating metal while they still can. The technical indicators are screaming warnings that most investors are ignoring. Gold's momentum indicators haven't been this extreme since 2011, right before the last major precious metals crash. The metal is trading in what analysts call extreme overbought territory. Under normal circumstances, that would signal a correction, but these aren't normal circumstances. When fundamental demand from central banks and institutions overwhelms technical signals, prices can stay irrational far longer than markets can stay solvent. History provides a roadmap for what happens next, but it's not encouraging. Every time gold has doubled from previous highs, the subsequent market crash has been worse than anyone predicted. The 1970s gold surge preceded double-digit inflation and economic stagnation that lasted a decade. The 2000s run coincided with the worst financial crisis since the Great Depression. This surge is happening alongside debt levels, currency debasement, and geopolitical instability that dwarf previous cycles. The most chilling part is the timing gold usually doubles after crashes begin, not before. The fact that it's hitting these levels while stock markets remain near record highs suggests the crash, when it comes, will be swift and merciless. There won't be time to adjust positions or hedge portfolios. The institutions driving gold to these levels aren't preparing for a correction. They're preparing for systemic collapse. And when that collapse comes, gold's initial reaction might shock everyone. Just like in 2008, the metal could crash alongside everything else as liquidity evaporates and forced selling dominates. But unlike stocks, bonds, and currencies, gold will recover. Because when the dust settles and governments are printing money by the trillions to keep their economies alive, the only assets that will hold value are the ones they cannot create out of thin air. The doubling isn't the end of the story, it's the opening chapter. So here's what you need to understand. Gold at $4,000 isn't celebrating. It's mourning the death of everything you thought was stable. And if you're waiting for some financial expert to tell you when to prepare, you've already missed the signal. The doubling has happened. The institutions with the best information on the planet have made their move. The only question left is whether you'll recognize what they already know. The pattern doesn't break, it never has. When gold doubles from previous highs, markets don't just correct, they collapse. When currencies lose their anchor to reality, societies don't just adapt, they transform. And when the monetary system that's governed global trade for decades finally snaps under the weight of impossible debt, the survivors won't be the ones who trusted paper promises, they'll be the ones who understood that gold doesn't rise because it's valuable. Gold rises because everything else becomes worthless. The doubling isn't a price target, it's a countdown. And time just ran out. If this opened your eyes to what's really happening, hit subscribe. History doesn't repeat, but if you ignore the warning signs, it will crush you all the same.